Today we're going to talk about what is a hot topic in the industry, corporate immediate financing arrangements, IFAs, particularly on the corporate side. The reason we've chosen this topic is that RBC is a relatively new player in the whole life market, and we know that. But RBC also knows that in order to play in that market, you need to have the concepts that go with it. And that was part of the reason why they hired me a few months ago, because we have a plan to beef up our tax and estate planning support. We think it's table stakes to play in this market. We know that we have a really good whole life product, and we know that we have to increase the amount of support that we're providing to you in the field as advisors. We're going to talk today about what is an IFA and how it works. Who is the ideal client? Because there are a lot of ideal clients, surprisingly. How does the concept work? Who does the lending? And I have sort of an announcement around that front. And then we're going to go through an example. And in particular, we're going to dive somewhat deep. I mean, we don't have more than an hour, but we're going to start to dive into our illustration tool that we've built for this, because it's something really special and there are some unique features that distinguish us from our competitors. Just by way of a quick show of hands, and I don't expect a lot to go up, so don't lie. How many people in the room have ever written an IFA? Yeah, that's about what I thought. I think I saw 3 hands. Understand, this is not a concept for everyone. And as we go through the what is an IFA, you'll see why. But when you find that client, the cases are big. Because the minimum on the lending side to do any of these, because they are financing arrangements, is $50,000 a premium a year. So we're not talking to anybody about this concept unless they're in a position that they can write a check for 50 grand each and every year comfortably and qualify in all the other ways that we'll look at. More typically, I would say the sort of sweet spot commonplace where we see most of these is between about 150,000 and 500,000. So what is an IFA? It's actually a very simple concept, and it's been around for a long time. We're just using the cash value of a permanent life policy, and this has been done in the past with UL. It's been done with whole life. It works best with whole life, especially in the absence of all the 10/8s that we were using when we could use them 15 years ago. But it's very different than other concepts. Most other concepts that we sell in the marketplace focus on insurance need. How do we provide a death benefit? This sort of layers on top of all that and matches up with any underlying insurance need that the person might have, whether it's estate preservation, they're doing an estate freeze, could be funding for a shareholders agreement that has a permanent need as opposed to a term need, because they're all different. They're doing a corporate estate transfer, an estate equalization, whatever they're doing, doesn't matter. We have to find that underlying insurance need, and this is just a different way of dealing with the premiums up front. Rather than paying money into a policy and leaving it there, you're paying it into a policy and borrowing it back. And that's really all it comes down to. What's special for the client is they have to be in a position that they have the ability to write off the interest. Now, I like to involve you, as you've already noticed. There are 2 things that you need besides enough income to be able to write off interest from a tax point of view. Anybody want to tell me what the Income Tax Act tells us? Come on, don't be shy. I know it's... What's that? It can be passive. It can be passive or active, but we'll talk about that. It's got to be reinvested, and it's got to be reinvested with a reasonable expectation of profit. So you have to borrow for the purpose of earning income from business or property. That's the wording in the Income Tax Act, and that's very broad, obviously, and that's why it covers the active and passive. It says business or property, and you have to have a reasonable expectation of profit. The reality is, for most business owners, when they reinvest in their business, when they're borrowing at market rates, they have a reasonable expectation of profit, just sort of, as we say in the legal world, prima facie, just like looking at it. Because when they reinvest money in their business, the reason they're successful business owners and you're talking to them about any of these ideas is because they get ROIs in their business at 20%, 30%. Like when they buy something, it makes money for them. The other thing, of course, the client has to have is sufficient capital to pay the premium. Basically refinancing, the interest is still deductible. I mean, there's some case law, namely, probably the most seminal case still in this area is a case called Singleton from, I think, all the way back in the mid-'80s, where basically you have to look at the direct use of the borrowed funds. That's what that case came down to. As long as the direct use of the borrowed funds is an income-earning purpose, you'll be able to write off the interest. But I want you to think about this in another context and why you can use it to pay off another loan and still write off the interest. If you owned a piece of real estate, a piece of a rental property, and you had a mortgage on that property, and RBC was your lender, and you decided because of what was going on in the market or whatever reason, you're going to move that mortgage from RBC to TD. Is the interest still deductible? Of course it is. You haven't changed anything just by changing who the lender is. And CRA has actually, right on the Canada.ca website, they have a whole thing on interest deductibility, and they contemplate in there the idea of restructuring finance. That's actually quite normal, and that's the most basic version of it. So thanks for the question. So who is our ideal client? Our ideal client is typically falls into one of two categories. They're either a business owner that has both high corporate and personal income. They have to have a sufficient risk appetite. And when I say that, they have to have it on two fronts. They have to want to take the borrowed funds and reinvest them into something. And they also have to say, you know, the last presentation, they talked about the conservative nature of whole life, and I get all that. And for most clients, in fact, that's how most of the whole life in the marketplace is sold, and it makes total sense. But they some people want to take a little more risk, and there is risk on the interest rate side with regard to the loan. Because we know, and you just saw it with Sun Life, and that's, you know, the nature of whole life. I think that goes for every company. The standard deviation of the returns on the par fund are very steady over time. Gains and losses are amortized over the life of every investment that's held within that portfolio, and that's why we're allowed to do that. We get some special accounting rules from CRA. But we've seen it the last couple months, what can happen to interest rates tied to prime or to bankers' acceptance on the lending side. They can go up and down. And somebody has to be willing to accept and understand that risk. It's not for everyone. And by the way, I'll say this as an aside. A lot of these cases where you propose an IFA end up being vanilla whole life at the end of the day. And from your point of view, that's probably better because you don't have a loan to apply for anymore. You don't have a loan to manage. You don't have as many moving parts because we've all got a little bit of laziness in us, right? Like we'd rather take the path of least resistance. And I'm going to tell you a true story around that. I spent a few years working for Canada Life as their tax and estate planner in Ontario. And I was there during the merger with Great-West Life. When Great-West Life came in, my new boss from London, Ontario, came up to visit me. And I was actually already negotiating a deal with Transamerica at the time, and I was praying I was going to get packaged out because I knew I had another job sitting there waiting for me. And he says to me, Mitch, you're doing the best job in the country. You're my go-to guy on the tax and estate side. And I'm like, what? Why are you telling me that, Carl? He said, first of all, I wasn't happy about it for obvious reasons. But I said, so tell me why. So we were actively marketing RCAs back then, retirement compensation arrangements. So I was probably doing 2 presentations a week. We had the most quoting activity, and we had the most RCAs settled in the country in the previous year. But I, having been intimately involved in the quoting, having come through head office, I knew how many that was. Do you know how many that was? 2. It was 2. for the entire year. But when they dug deeper into the numbers, and this is the key message and why it's good to know about this stuff, even if you don't always have the clients and you can talk about it, over 50% of the people who got RCA quotes within my territory ended up buying Canada Life product. Now that is a decent closing rate, right? Like that's okay, especially at the insurance company level, because I'm guessing if 50% of them bought Canada Life product, that it's a bigger number that actually bought insurance. And from your point of view, you're trying to sell them insurance. So I think that that's an important thing to keep in the back of your mind as we're talking about all this. I think the most ideal candidate, and you'll understand why when we go through an example with numbers, is the client who has a holding company, whether it's assets that have been parked in the holding company because they are a business owner, whether it's because they sold a company, whatever the reason is, but they've got significant assets sitting in a passive portfolio in a holding company. For them, it matches up very well with what you heard in the previous presentation about introducing that fourth asset class, insurance, after their real estate equities and fixed income, and passing more money on to the next generation. And this just gives it an extra little kick beyond the insurance on its own. So mechanically, how does it work? We establish that insurance need. And it goes back to what I was saying a few minutes ago. If you've established the insurance need with the client, then there's an insurance sale to happen. If the funding it using an immediate financing arrangement doesn't work, or it's not what the client wants, they still know that they need the insurance. And so you've got your sale. And by the way, I spent 10 years in your seat as an advisor, so I know what that's like. Then you have to go out and you have to underwrite that corporate loan. And I'll talk about the who lens and some of the mechanics later on and what we're doing to help you on that side. But this is not easy lending, in the sense that you don't just walk into a bank branch just because you've got money and do an IFA, because there are enough hoops that you have to jump through to make sure everything works on the tax side, that you don't definitely want the banker at the branch level doing it. And the other thing is, most of them actually don't understand this. It should be the best kind of, easiest kind of lending that they do. In a way, it's better than mortgages on real estate. Because when you think about it, what do banks look for when they're lending? There's two things. A lot of twos today. What are the two things banks look for in clients when they're lending? What do you have to do to qualify? Credit and collateral, I heard. Those are the things. Ability to pay and security. That's when they have those things. Ability to pay doesn't change with the collateral. But think about insurance as collateral for a loan as opposed to real estate. I don't know if any of you have ever seen someone who's gone through yourself or studied, and being a lawyer, I kind of had to, the mechanics of a power of sale. When a piece of real estate goes into power of sale, there's a waiting period before the bank can act on their security. They have to give the person enough time to catch up on interest before they can act. Then they're in the real estate process, list the property, sell the property, wait for closing. I mean, you're talking about an extended period of time. Insurance as collateral is cash sitting in another financial institution. Once they have a collateral assignment, if they have to act on it, they can get paid in a matter of days, not weeks or months, or maybe even a year. So it's great security. You have to seek the loan. We're gonna, as I said, come back to that and talk to you about some of the options out there and who's out there doing it and what we're doing to help. Sometimes there's additional collateral necessary, and that comes down to that security side of things. Because most of the lending that you've looked at over the years, I'm sure, with life insurance is cash value lending, right? Like IRPs and stuff like that, where you're lending or borrowing against the cash value to create a tax-free stream of income somewhere down the road. But here, very often, you're borrowing back 100% of the premium, and as we all know, the cash value is less than the premium in those early years. It takes time because even though on a whole life you don't see surrender charges, they're like you did in the UL world, but they're there, because you guys get paid up front and we can't pay you and pay the client if they decide to cancel after a year. There isn't enough money. So it takes some time to get there. So you need that additional collateral if you want to borrow back 100% of the premium. And we'll look at some numbers. You'll see it's actually not as bad as people think. And we'll talk later on about the nature of that collateral. Annual interest versus capitalized. Most, and I almost always advise to pay the interest annual on these. And the reason I say that is because as the loans get bigger and that interest number gets bigger, even though you're not paying it and the policy might support it, the amount of taxable income that someone needs then to cover that interest deduction and take advantage of it starts to get ridiculous. Like absolutely ridiculous. Like I've seen examples, and especially in the 10-8 world when interest rates were 10%, like you can imagine capitalizing that year after year, where someone who's very successful, maybe earning $500,000, $750,000 a year now, is setting this up, and the amount of income they need to show to take advantage of the interest deduction when they're 80 years old is $3 million. Like that's asinine. Like it just doesn't make sense. So typically I don't show capitalized interest unless somebody wants to see it. I can tell you Mariella, who's at the back, our wholesaler, we're looking at a case right now where somebody's looking at partially capitalizing, which is a little different and sort of keeps that under control a little. We're still trying to figure out if we can illustrate it, but that's a whole other story. Loan payback. Typically when we're illustrating these, we're illustrating the loan being paid back at the passing of the client. We're using the death benefit proceeds to pay back the loan. But there is the option, especially if someone sells their company and just wants to walk away with their insurance and they're sitting on some cash and their income is not going to be what it was potentially, you can always pay back the loan. These are typically open loans, so that's not an issue. And we have the capability to illustrate a loan payback at any particular point in time. What I just told you about the mechanics, I've just put it up here graphically just so you can see it and understand it. When the life insurance is in force, step one, the company buys that life insurance. The life insurance policy is assigned to a lender, and we get a loan or a line of credit from a restricted financial institution. That's an Income Tax Act defined term. I'll talk about that in a little more detail in a few minutes, but it's almost, pardon me, any public lender. Banks, credit unions, Caisse Populaire, trust companies, insurance companies, they all fall within that definition of a restricted financial institution. The concept, as it's illustrated by pretty much all of the insurance companies, does not contemplate using a private lender. That doesn't create problems on the interest deductibility side. It's on the premium and NCPI deductibility side, but we'll talk about that in a few minutes. And the borrowed money is then invested back into the business or into a passive portfolio for the purpose of earning income from that business or property. When the death benefit is paid, this is where things get a little bit of interesting. The life insurance proceeds pay into the company. They pay tax-free. They create a capital dividend account credit based on the entire death benefit less the ACB of the policy. Then the bank gets paid back. They're collaterally assigned on the policy, so they're going to get their money first. The company gets the balance of the life insurance proceeds, but they get the CDA credit based on the whole death benefit. So there is an opportunity there to possibly move other assets out of the company, particularly where you've got a holding company. Obviously, you're not going to be moving machinery out of an active business into personal hands, but where it's a holding company, it makes a lot of sense. You've got more capital dividend account to move money out tax-free to the next generation. So let's talk about some of the subtleties, the tax stuff, the stuff that I find fun and probably keeps some of you up at night sometimes. I mentioned before that the proceeds of the loan must be used for an income earning purpose. Could be a business, could be passive portfolio, could be real estate. Again, going to case law, another case that came out at the same time as Singleton, there were 3 of them at the time, Shell Oil. What the Supreme Court talked about in that case is when they talk about reasonable expectation of profit, profit is defined in its broadest terms. Someone who's investing shouldn't be using the Income Tax Act to decide how to invest. And when I say that, what I mean is interest, dividends, capital gains. From a definition of profit point of view, the Supreme Court has defined profit to include all 3. What they went on to say, which was interesting, is there has to be a reasonable expectation of some income. It doesn't have to be enough income to cover the interest expense, but there has to be some income, and overall you have to be profitable for you to be able to write off the interest. I think the biggest thing, and I talked about this with the capitalizing interest issue, you have to have sufficient income to take advantage of the deduction. You always have, the concept blows up if the interest is non-deductible. And if it's non-deductible because you don't have income against which to write it off, doesn't make sense. You might as well just buy the insurance then. I mentioned risk appetite already. All clients, and I don't think any of us in the room are in a position to provide independent tax advice to clients. When it comes to this, accountants and lawyers will pretty much always be involved. Clients' accountants don't always have the right perspective on this because most clients' accountants think in terms of sort of this year's tax return, next year's tax return, and 1 year later in their planning. But tax accountants, as opposed to those kind of what I call audit accountants, take a different view. And a lot of the mid and bigger sized accounting firms do have that service within their firms and will enlist the practitioner who can help. Inevitably, lawyers are involved in this process, and I know that's a scary thing and people hate dealing with them, but almost any time there's any kind of commercial lending, lawyers have to be involved to provide an opinion. Because when you do an individual loan, you're standing in front of the banker. You can show them your driver's license. They can see you're warm-blooded and you're a person and you're there. Companies are a little different, right? Companies are a creature of statute. So a lawyer has to give an opinion to say things like the company is properly constituted. They have in their bylaws the authority to take out these types of loans, that the person who you're dealing with as a director of the company has the authority within the resolutions to be acting, things like that. So they're typically providing an opinion with regard to the company that it can actually take the loan that's being proposed. And the borrowed funds should never be used to pay the insurance. It has to go the other way around, because it comes back to that direct use of the borrowed funds. When you borrow for the purpose of buying an exempt life insurance policy, you cannot write off the interest. That the Income Tax Act is really clear on. You have no reasonable expectation. You might have a reasonable expectation of profit, but there's definitely no income coming from an exempt policy. And besides that, there's an exemption within Section 20 that says if you buy an exempt policy, you can't write off the interest. Full stop. Premium deductibility. This is one of those things that I think is a little bit overrated in terms of its importance in making this concept work. It's almost like an extra little added bonus deduction. If you focus on the interest deductibility and it all works, then this will just make the deduction a little bit bigger. And that's for a few reasons. First of all, you're only entitled to deduct the lesser of the premium and NCPI. That's in paragraph E.2 of 20 sub 1 of the Act. As really the only circumstances under which you can write off insurance premiums. And you've probably seen that provision before and lots of people talk about it. But you have to meet a bunch of criteria in order to qualify for that deduction. The loan has to be advanced from a restricted financial institution, which I mentioned is basically any public lender, just not a private lender. The loan interest on its face has to be deductible. So if we did the concept right, we've got the interest deductibility, so we're good there. The institution has to require the policy as collateral for the loan. And that's one of those things why I said, like, you don't want to do this with the branch banker because they might miss that one. So it's not just that the policy is collaterally assigned. That's not enough. There actually has to be a provision in the loan that requires the insurance as collateral. And even then, and this is why I say this is only really a small add-on, it's restricted to the amount that can reasonably be considered to relate to the loan. So, you know, if you've got a $20 million death benefit and a $1 million loan, at most, you're only taking 5% of the lesser of premium and NCPI. That's the way all the insurance companies run their illustrations. That we limit it to the ratio of the loan to the death benefit, which makes sense. And the other thing we have to think about are sort of the pushes and pulls and product design and all of this. There's no deduction here once the premium period expires on a 10 or 20 pay policy, right? Because there's no more premiums. It's different if you've got a life pay with an offset, because premiums are continuing to be paid. That might not work as well from a capital dividend account point of view, but premiums are being paid by dividends at that point. So there still are premiums being paid. So we just keep that in mind. And let's just talk about the capital dividend account for a couple minutes. One of my favorite provisions of the Income Tax Act when it comes to insurance, because it's what makes all the corporate-owned policies so much better than a lot of other investments from a tax point of view. You can have a conservative investment with a great rate of return because of the capital dividend account. In its simplest terms, and it wasn't like this the last time I was doing this 14 years ago, it is always proceeds less ACB. That's the amount that credits the capital dividend account and can be paid out to any Canadian resident shareholders tax-free. And that Canadian resident shareholder requirement for capital dividends, we have to keep that in mind when we're talking to our clients, because they might have 2, 3, 4 children. Some live offshore, some live here. You know, and so how do we do their overall planning so that we make sure that the CDA is maximized? I mentioned before that the loan is paid back out of the proceeds, and there might be some additional CDA to distribute other assets. For some clients, that's a real big bonus to this, because you're saving, you know, on non-eligible dividends. In Alberta, I think it's around 42, 43% tax. Like, it's a significant number. So we don't want to miss that or not take advantage of that. Now, who does the lending? I've got a few names up there. They are not the only names. This list is not exhaustive. But what I'm excited to talk about first is EQ Bank, because we officially struck a partnership with EQ Bank. We kind of closed that deal last Wednesday, just in time for the first IDC meeting, so that we could tell that group of IDC advisors that you are the first ones that get to hear about it. You know, so I can't promise for how long. For now, we're only sort of actively marketing that we're in this with EQ Bank, because our head office people have some fears about volume, and I think they're completely out of touch with the number of people that actually buy this concept. It's very few policies, very large premiums. So I think their fears will be allayed, but senior management will be happy because of the size of the premiums that we bring in. EQ Bank will be great to deal with. We've built a whole back office with them for communicating information about clients who engage in this concept, to ensure that the loan to value ratios are maintained within acceptable limits, that the client doesn't have to think about that, you won't have to think about that. It's just going to be nice and smooth and all happening in the background, and it only becomes a problem if the client goes offside. We also know with whole life, you never have negative returns. And if you're not capitalizing interest, typically is never a problem. The other comment I'll make about that, and this doesn't just go for EQ, it's probably for all lenders, I won't even say in crash testing, if in determining suitability for any of these, they're almost always using -1, not current, to determine whether they're willing to do the lending on these. They need to crash test it, because what happens when they use -1, they know in the first 5 years of the policy, they're going to be ahead of the game in terms of the amount of security, and it's very easy then. They're not going to have policies that they're having to, upon which they're having to call the loans, act on their collateral. Nobody wants to do that. I know a lot of us hate banks sometimes, but banks are in the business of lending money. That is how they make money, right? They want to lend money, and they want to lend money that has good security, so that's why they do it. Manulife Bank, while I can't announce an official partnership at this time, we are talking to them about moving on to their platform as well in a more official way. They will lend against RBC policies now. They are comfortable with us as an insurance company, obviously. We're as big as anybody, and they're not worried about credit worthiness and stuff like that. So, but we're going to form a similar type of partnership, I would expect, in the next 6 to 9 months with Manulife Bank. With BMO, we have more of a casual relationship for now, and I see that one is progressing a little bit slower. Now, BMO lends on these policies at a minimum first-year premium of $250 grand. So you're already into the much bigger IFA cases. They don't even want to look at these if they're not lending, let's call it $2 million. They might make some exceptions for current BMO clients who are on the private client banking side, but really they don't want to look at these unless they're very large, but their rates are typically better. It's a little more intricate process to get the loan, but they are very, very good at it in that market. I don't think we're in a ton of danger of these being legislated out, because the concept of borrowing to reinvest is clearly something the Income Tax Act contemplates, and providing security for that loan in the form of life insurance is just another form of collateral. So I don't foresee that, but having them tied together from the same institution, even though I know RBC Insurance and the bank and all of our other arms are separate companies, we're trying to stay away from that perception at the end of the day. If you or your client had a relationship with RBC and went sort of separate from us to talk to RBC about it, it's not an issue, but to have a formal program, we have some concerns. Typical lending criteria, client has to meet the minimum institutional lending side, as I mentioned, with some of the niche lenders in the insurance market. 50,000 is the number. With some of the big banks, you're talking 200, 250,000. But I can tell you there's money out there. When I was in your seat, I had a friend who worked at TD, and they have an area that probably no one in here has dealt with called national accounts. And I knew him from my days when I was doing this job. And he would call me literally every 6 months and says, "Mitch, do you have some clients that need to do some insurance lending?" I'm like, I would come to you. You're a friend. I'm going to come to you if I have those kinds of deals, but they're few and far between. I'm not definitely focused on that. Yeah, Mitch, I got $100 million I got to get rid of before year end. So there's money out there. There is money out there for this, because like I said, banks are in the business of lending money, and they want to lend money where they have good security, and that's what this is. Wealthy, successful people who can put up good security for a loan with a clear, concise, and sensible strategy. That makes sense from a business point of view for banks. The collateral assignment we've talked about ad nauseum. They are still financially underwriting these loans. This isn't like in the day, there are no shortcuts there. Clients are gonna have to provide financial statements and you know, have lights shone up whatever body part that the bank needs. They're like almost worse than the medical tests that come with the insurance. But when you're underwriting a large life insurance case, especially if you get into the inspection report world, you're probably already there with the client and gathering a lot of that information. The client's piecing it together anyways, so you're good to go. Sometimes there's additional collateral, and I'm going to show you in our illustration tool how that works. And we talked about the why, and we already talked about the legal opinion. So let's get into a case study, because I like looking at the pretty pictures and lots of columns. And this is a struggle we've had with this, with the illustration, or at least that I have. As someone who's been around this business a long time, I don't view illustrations as sales tools. I view illustrations as compliance tools. Because CLHIA told us we have to have illustrations that show all these different things that we have them. They're not usually great sales tools. What we're trying to do with this one is it looks like an illustration and it does have tons of columns, but we realize with this concept that there are certain reports that you can sort of focus on with the client and spots where you can say this is what you need to focus on. But we also have to have those reports that the accountants can dive deep and say, okay, here's what we need to do, here's why it works, here's where the deductions come from, here's why the estate is going to be bigger. So we're trying to be a little bit of something for everyone. If you're hunting for the insurance need first, it's what makes sense there. And like I said, this is just a different way to pay the premiums up front rather than leave them in. Most of the time, though, I will say in my experience, buying whole life in an opco doesn't make sense. Most of the time, for creditor protection reasons over anything else. Because if the client doesn't have a holdco, and remember, we're talking about big premiums here. The client, if they don't have a holdco, but it really should be in a holdco, I know because I practiced law for a few years, to go to a good quality small to mid-sized firm to do a Section 85 rollover and put a holding company in place, including incorporating the company. I can speak for Ontario, including all disbursements and taxes, about $5,000. So it's, you know, if somebody's doing this for $100,000 a year premium and $100,000 a year in deductions and all that, if they can't spend $5,000 up front to make it work, they can't see the forest for the trees. So you want to be able to write off the interest rate against passive income, which is at a higher rate. Deductions are more valuable when you're paying tax at a higher rate. So we've got Jane and Fred here. And like, I'm trying to make ideal clients, not real clients. Understand that, and I know that. We do that with all of these case studies. They're both 45 and healthy, non-smokers. They've got a successful business. They're looking to expand, so they have a need to reinvest. Typically, this concept, you're not aiming at startup companies because they probably don't need the whole life insurance at that point. You're looking at fairly mature companies, but that still are growing. They own their shares indirectly through a holding company. See, I already made sure they had a holding company in my ideal example. And they've got young kids, so there's lots of insurance need established. I'm trying to sort of, I'll admit, assume away the insurance need itself, the pure need. They've got kids, they've got future capital gains tax liability, and they got lots of tax problems. So OPCO is earned close to or greater than the small business limit every year. So they're taking advantage of the small business tax rate, but they're still having to pay some high taxes personally. And they are consistently having a combination of investing back into the business and paying some net profits up to the holdco, to the point that over the life of the business and their investment returns, they've saved $3 million. And they're consistently putting more money in every year. In terms of product setup, I made this big. They're going to pay $250,000 a year in and on a joint last on a 10-pay basis, get as much cash value so they could borrow as much back without providing too much collateral. Face amount calculates out at $4 million, which, you know, if you look at the rest of the profile, you could see that's an easy face amount to justify in these kinds of circumstances. And because I'm giving this presentation across the country, it's not personal to you in Alberta. I tried to use sort of proxy tax rates that would be universal right across all provinces. 50% corporate passive tax rate, active business, small business rate, 12%, and non-eligible dividend rate of 45%. There's a lot of assumptions you see here. And this is the part of the illustration. And more, by the way, more assumptions means more room for error and the more likelihood that your illustration will be wrong sooner. So one thing we know about illustrations is that they're usually wrong, usually within a year, almost for sure within a year. With UL, I used to be able to say like literally the next day they were wrong. But with whole life, you kind of have a year because you know what the dividend rate is right now. And that's not changing. We're assuming the loan interest rate to be 5% for the first 5 years, and just to be safe, we're going to boost it up to 6% after that. Because we are seeing interest rates rising right now, and we don't know where things are going to settle. Loan to CSV limit, cash surrender value limit at 90%, that's pretty typical. There are some institutions on whole life that'll go up to 100, but 90% is nice and safe. And they won't do that on UL. They never would, even on fixed income in a UL. But on whole life, there are some institutions that will go up to 100. If you're dealing with one of those institutions, we can illustrate it. You just tell us. Loan to other collateral limit, we're going to assume 100%, just so that the clients can get an idea of how much other collateral. Again, with that other collateral, it depends on the nature of the collateral, the extent to which the lender will require it. If it's something that is very volatile, they may say it's 50%. They often are getting something more broad than that, like they're getting some kind of general security agreement. They might be standing in line with some other creditors. Every case is a little different. That's why commercial lending is very different. We set in our illustration the loan to death benefit limit at 100%. If the client's paying interest every year, this never comes into play anyways. It only becomes an issue when they're capitalizing interest, because the loan could actually get as big or bigger than the death benefit, in which case, why the heck would you do this? We're assuming that it is an immediate financing arrangement, that the client is going to borrow immediately after the premium is paid. And it's 100% premium financing with that additional collateral provided. And what I'm doing in this illustration, because we had the comment, I believe you talked about active and business tax rates and you want to get the higher deduction. I'm going to show you the effect, because we're capable, depending on the client situation and what you want to show, of showing active business tax rate, passive business tax rate, or both within the same illustration. So they can see the effect that if they didn't have the passive income for the write-off, what it looks like against active income. You should know that you do have to go through our life wholesaling team to get one of these illustrations. It is not built into our software. We, for a whole bunch of reasons. One of the biggest ones is, and by the way, none of the companies, I don't think have this built into their illustration software system. They all sort of keep it in head office. A, we want to know when these cases are coming in because we want to support you on them. B, it's given us the flexibility that as we've only been working with this tool for a couple months, when we find something that we can improve, it's not definitely something wrong, but we're working with the field, we're finding all kinds of, we're getting tips from our advisors about things they'd like to see. It's actually, even though it looks like what comes out of the fancy software that has to get distributed out to you, it's actually Excel-based. So we're using Excel, and our actuarial and tax teams are working in the background and are constantly improving this illustration. It also gives us some flexibility where we have special requests to be able to sort of dive in and make little changes in the programming to make this work. So I made myself the advisor because I love selling $250,000 premium cases. just, just from a marketing point of view, when a client's looking at this illustration, there's all the verbiage, soft stuff. What is an IFA? How does it work? The pictures you saw a number of slides back, just so they can see the mechanics. Different people see differently. The steps to establish it, which we talked about, and a lot of the benefits that we've already talked about. And then they get into this sort of, let's call it combination insurance IFA summary, because like when you look at a normal insurance illustration, the tax assumptions typically stop like there, like there's one number, and you have the information about the insurance policy, but you've got all this other stuff going on. So we've built it all into the front so you can see it all in one place. And then you start getting into numbers. Now, I'm not gonna spend a ton of time on this, but I just wanna show you some of the different reports. I didn't even put them all in, but there's a lot of stuff in this. So what we show them first is all the insurance values and loan values to see what's happening up front. The big thing here is, because remember, we're just setting this up as a true IFA with immediate lending, $250,000 using outside money. We're reminding them right at the top in the very first column, paid with external funds, and then they're borrowing it back. I think what you can notice here, I think the biggest thing on the lending side to notice that if you're paying interest annually, the loan interest stays at a steady amount. So when I talked about suitability earlier and being able to take advantage of the write-off, that's the big number, that the client in the company is long-term going to have $150,000 of taxable income to be able to take advantage of this deduction. That can get complicated on the active business side. On the passive side, portfolios can go up and down, but you kind of usually have a clue. You shouldn't be skating anywhere close to that $150,000 of taxable income in the company if they're suitable for this size of IFA. And I want to show you the additional collateral. So I'm going to just walk over here. What you can see is there is quite a bit of additional collateral required. That's what's being added. But you can see that after the premium paying period stops, and as the cash value grows, it's getting released every year to the point that by the time we're 20 years out, there isn't any additional collateral beyond the life insurance policy to keep this loan going. Now, typically these clients, the way most of these plans work, the lenders are looking at 10 years up front, and they're willing to extend the loan for 10 years, but no lender will extend the loan forever. The only ones who are silly enough to do that are insurance companies, because policy loan provisions are always available. So just understand that at some point, the client is going to go back to the bank and have to renegotiate the loan at current terms. The other thing I'll mention though is, when you're dealing with an insurance company that builds these partnerships with the lenders, the monitoring of that loan during that could be even as little as 5-year period, but more likely 10-year period. You don't have to worry about any extra reporting, like having to call us up and get in-force illustrations and statements and things like that. Like, we're dealing with that all in the background on your behalf. This is just taking those numbers out a little further. You can see that there's a column there, annual loan repayment. If the client wanted to pay back the loan at some point, other than by way of the death benefit, we could trigger it in there and they could see what the illustration looks like and how there's no more death benefit net of loan at the end, there's just death benefit. Now I've run this at current dividend scale. I mentioned the banks look at -1, and when you ask us for one of these illustrations, we always produce 2 illustrations. So we run it, it's too complicated to put the current and current -1 all in one. Just our system automatically spits out 2 completely separate illustrations, one at current and one at an alternative dividend scale. So if you want it to be -2, it can be. I don't think, it's not a likely scenario. That's kind of like the world is coming to an end kind of scenario in the life insurance world, but don't quote me on that. And I mentioned before the passive income tax rates and active income tax rates. So if you ask us for both of them, we put them side by side on the illustration so you can see net cash flows every year. And this is really what drives it, right? And you'll see it again in one of the later reports. But the net cash flow to cover that interest cost when you're only writing off at 12% is $132,000 a year. Whereas if I'm writing off at 50%, that net cash flow is only $75,000 a year. And when you look at IRR on the net death benefit, if you've got higher cash flow, that's going to decrease your rate of return if you've got higher cash flow out. By having the lower net cash flow out, it helps support the IRRs. And you can see even by the 20th year, using the same insurance policy, the same money reinvested, whatever else is going on, and the only difference being the tax rate at which you're taking advantage of the write-offs, you can see the effect. And I believe I have one more. You can see as you go out to death, if you're writing off at the active business tax rate and it's costing you more, your IRR at year 60, I mean, our clients would have to get out to over 100 there, but let's go up to year 50, 4.2%. The insurance on its own would have given them an IRR of 4.7%. So why would you do it? You're doing it if you can write off at passive rates because just by using the Income Tax Act, you get a 1.5% lift on your returns every year. Every single year. That's worth it. We get into the nitty-gritty in the illustration. We go through all of the deductions. These are all values with the IFA. It's not a comparison against IFA versus non-IFA in this case. This is for the accountants. They need to see all of these deductions. And, we show what the NCPI is every year, the premiums paid. You can see, because I used a 10-pay just to show you what happens, the lesser of premium in NCPI goes to zero when there's no more premiums. If we were in a life pay with offset where we were putting in $250,000 a year, the numbers would look different. These are the things we can play with and talk about when you have a specific case on the table. Establish the insurance need first and the rest will flow. I mentioned earlier that the reasonability test around that premium and NCPI deduction, so we're applying the loan to death benefit ratio against the lesser of premium and NCPI to determine the size of the deduction. And I said, focus on the interest deductibility, not on this deduction, because look at the size of this deduction. Right? It's small compared to the $150,000 that you're deducting at a 50% tax rate and saving $75,000. Don't focus on the $1,800. Okay? In some cases with life pay and a big premium, you might have big deductions on this side, but you also then are potentially reducing CDA on the other side, and I could spend another 10 minutes on that, but we're not going to. The question was for anyone who didn't hear it, what are the average expenses? I don't know that there's an average number because there's a big difference between a $50,000 a year IFA and a $500,000 a year IFA. Because when you're into those $500,000 a year IFAs, you're probably looking at 10 grand worth of expenses because the legal opinion that the bank is going to require is so much more complicated than it's going to be on a $50,000. Like on a $50,000 a year one, bank's literally just going to say, like, is this a company and can they be doing the loan? But there's a lot more. And I remember as a practitioner, I did a banking opinion for a very large loan, for a $10 million loan. And that was like a nice billable because what the bank required, the level of due diligence that the lawyers had to do that was way beyond the financial side is so much different. The number of searches we had to do was insane. And I think it was about a 20-page opinion by the time I was done. So those ones can be expensive. It's very inexpensive on the small ones. The banks aren't asking a ton, and it's the legal opinion that really is a big thing. What's unpredictable is how much the client will get in terms of their understanding and how much has to be explained by their accountants and lawyers, because that's another upfront cost that's unpredictable because they don't work for free. So just as I wrap up here, just a few key points about our illustration, things that we've done so far to distinguish us from our competitors. As I mentioned, with the support of your wholesaler, your SSC, we're producing all of the quotes. We can illustrate 2 loan rates. I don't believe any of our competitors are doing that right now. Like, you can change the loan rate. You can have one rate for a certain number of years and then increase it. Both active and passive rates for the write-offs is not only possible, but you can show it on the same illustration so the client can see the effect of that. We're automatically producing all the illustrations at both current and an alternative dividend tax rate, dividend rate, and we can start the loan from any year during the payment premium. We've demonstrated here an immediate financing arrangement where it's year 1, but if somebody didn't want to put up additional collateral, just by starting at year 2, you often can get out of that additional collateral requirement. And if, God forbid, you get to that point where the loan starts to exceed the death benefit, which only happens with capitalizing interest, our software automatically calculates a loan repayment. Some people want to pay nothing. Some people want to pay nothing out of pocket. So never say free insurance to a client, because it's never free insurance. But that's the way some advisors market it, and it's a misnomer. But what they say is, you put premiums in. You have to be able to write the check, and not everybody can write the check. You have to qualify for the loan. But if you get 100% of your premiums back almost immediately, like in a matter of days, and you never pay interest, the argument is whatever's left is gravy. You put nothing out of pocket, but there's not going to be a lot left. What's that? And the cream is the write-off every year. That's giving you cash flow, net cash flow. The question was, where I have 2 spouses who are both shareholders on the company, would I typically do a joint last? Very often, yes. It's not 100% of the time, but it comes down to figuring out what the insurance need is up front. You've established the insurance need, whatever it is, and if it is like a corporate estate transfer or terminal tax liability, it usually is joint last to die. So that usually makes the most sense.